Everyone, welcome back to my channel. If you are new, this is Pat's channel. We talk about self-development, self-improvement and remote work. Enjoy. Understanding the stock market. Hello everyone, today we'll be talking about the stock market for those that do not know anything about the stock market. So this is an introduction to what the stock market means, the terms and the basics that you need to know to become an investor and to start buying your stock. So let's get right into it. The first question that will come to your mind: you've heard of stock from different platforms, you've heard of stock, you don't even know what that means. So what is the stock market? What is a stock? A stock is a stake of a company that can be bought and sold in the stock market. You are buying a little bit of stake of a particular company, and you can buy this stake in the stock market, and you can also sell this stake in the stock market. So when you buy a stock, you can also sell it, so it gives you peace of mind that you're getting your money back. When you buy a stock from a particular company, it gives you a little portion of their profits, their decision-making process and their assets. This means when you buy a particular stock, you'll be getting a little bit of it from the company, you'll be getting a little bit of their assets, and you'll be involved in the decision-making process of the particular company. So literally, that's what stock means. You can also buy other things in the stock market. It's not only stock you can purchase from the stock market. Probably you're someone that loves to go for lower risks. You can decide to delve into ETFs. Meaning of ETF. What is ETF? ETF is a bundle of security that can be bought in the stock market. So like I said, ETF is a bundle of security that can be bought and sold in the stock market, bundled together based on different factors such as assets, industry, asset type, or geography. Before a stock is introduced to the stock market and for end users to buy, there's something that is called IPO in the stock market, and the meaning is initial public offering. What is initial public offering? Initial public offering, explain. We cannot talk about initial public offering without talking about primary markets. So let's delve into primary market first, then you will get the meaning of initial public offering. What is a primary market? The primary market in stock. Primary market is when a company sells stock to investors directly through a process called initial public offering. As you can see, it's intertwined. So they sell this stock in the primary market to major investors, pension boards, or mutual funds. Okay, we have primary market and we have secondary market. What is secondary market? The secondary market in stock. Secondary market is when you buy stock from a registered broker. The stock is already made available to a registered broker on SEC, and you go ahead to purchase it as an end user from the broker. The stock in secondary market are sold by investors that already bought from the company. An investor, you are not buying directly from the company, you are buying from an investor that has bought from the company. So you just purchase from a registered broker. Meaning of bull and bear market. In stock market, there's something we call the bull and bear market. What is the bull market and what is the bear market? Now, what is the bull market? The bull market is when a stock price rises significantly over a certain period of time. What is bear market? Bear market is when a particular stock of a company, the share price reduced over a significant period of time. It's when it reduced 20% from the market price. So that's what we call a bear market. So probably you bought a stock at the rate of $130 and it reduced 20% from the normal rate. That is what we call a bear market. Bear market is a good opportunity for investors to purchase more stock of a particular company. If the company has good potential of performing well in the future, when the stock price go down, this is a good opportunity as an investor to buy more stock of the company. But make sure you make your research to know that the stock market is going to do well at that particular period of time. Then you can decide whether you are going to buy more stock or sell. Meaning of market capitalization in the stock market. And let's go into market capitalization. What is market capitalization? Capitalization is the total value of the company share, the total combined value of all the shares of the company. That is what we call market capitalization in the stock market. Meaning of large cap company in market capitalization.
In market capitalization, there's something they call large cap company. These are companies that have total worth of shares over $10 billion. Companies like Coca-Cola.
Other types are mid and mega cap company. Know these things before you purchase your first stock.
Things you need to put into consideration before buying a particular company stock. You need to check the market capitalization and to make sure that you are making a good investment by buying the stock.
Meaning of dividend in the stock market.
The next topic on that is dividend. Dividend are payments made by public listed companies to their investors as a reward of investing their money with them. This means a particular company set aside the profit they make from a particular period to a particular period to pay their investors dividend as a reward of investing money with them over a particular period of time. Some companies pay dividend, but there are some companies that pay dividend to their investors. Apart from dividend, there's also something called capital appreciation in the stock market. Capital appreciation is the increase in the stock price over time. Let's just say you bought a stock at the rate of $120. Let's just say in between the period of 1 month, the company stock increased to $130. That's capital appreciation. This is the increase in the stock price over time. So let me just give a vivid explanation for those that will not understand. You bought a stock from a particular company that pays dividend. Let's use Naira now. You bought a company stock at the rate of 350 Naira per 1 unit. You bought 100 units of the stock, right? Over 2 months or 3 months, the price of the stock increased to 450 Naira per unit, right? So this means you are getting capital appreciation. The capital you invested in buying that particular stock, it has increased, and you see an increase in your money over time. That is what is called capital appreciation. So apart from the capital appreciation you're getting from the stock market, you also get paid dividend. That's if you buy stock from a company that pays dividend. So you are getting 2 different returns from your investment. Is that now, how do you know a company to invest in? As a beginner, you're just starting off. You don't know what to do. You don't know how to invest. You don't know how to make your research to know what company to invest in and what company to not invest in. These are the things you should look out for on what company to invest in. Number 1, you need to look into the earning per shares. The higher a company earning per shares, the more profitable the company is, or the more profitable the stock is. So if you see a particular company and their earning per share is higher, trust me, is worth investing in. But there are still other things you need to put into your research to make sure that this is a good company to invest in. EPS, such as earning per share, is used as an indicator to see how profitable a company stock is. Decide if this company is good using EPS, earning per shares. You need to see their earning per shares consistently over a certain period of years. You check how their history, their earning per shares from 2010 to 2025. You see if it is consistently high, right? So you check to see if it is consistently high. If it is consistently high, trust me, this is a good company to invest in.
The second one is price to earning ratio.
In the stock market, there's something we call price to earning ratio. What is price to earning ratio? Price to earning ratio is the measure of company stock price relative to its earnings. This is the price an investor is paying for $1
of the company shares. The third one is I per ratio.
Then there's also something called high per ratio. This is used to compare companies in the same industry, know how to invest and the best to invest in. Probably you have a particular company in the same industry. How do you compare and contrast to know which company to invest in? You use I per ratio.
The fourth on our list is dividend yields.
Another thing you need to check again is the dividend yield. What is dividend yield? Dividend yield shows how much dividend the company has paid over a certain period of time, which is usually a year. They are usually expressed in percentage to allow for comparison with other companies in the same sector. Note, be careful of higher dividend company. If you see a particular company and they pay higher dividend, their dividend is so high, like please be so careful of that. Don't just take your money and just invest it into this because you realize that, oh, they are paying so much dividend, let me put in much money. If the company is putting out more money than they are getting, obviously the company will run down over a particular period of time. So be careful of companies that pay way too much dividend.
How to calculate dividend yield in the stock market?
How do you calculate dividend yield? You calculate dividend yield by making your calculation as this: amount paid to investors per shares over price of shares sold in the stock market times 100%. That's how you calculate your dividend yield. So let's say the amount paid to investors per shares is $3 and the price of shares sold in the stock market is $70. So it will be 3 over 70 times 100%. It will be 3 over 70 times 100. That's how you calculate dividend yield. Another thing you need to look out for again is the debt to equity ratio. So this compare what the company owns and what the company has presently. Company with higher debt, obviously, they have more risks attached. So if you notice a company has higher debts, just avoid the company straight up. The lower the debt to equity ratio, the better it is. Obviously, we all know that a company that has lower debts is better to invest in than a company that has high debts to pay over a certain period of time. So this is something you should also look out for if you are investing or you want to buy a particular stock of a company. Now we've talked about what you should look out for and how to make your research if you want to buy a particular stock of the company. How do you now know the stock to buy? There are different analysis you can put into practice or into your research to know the preferable stock to buy over a certain period of time. The first one we're talking about is technical analysis. What is technical analysis? Technical analysis study a company based on their value and their price. So value is the number of stock that has been traded in the stock market over a period of time. How investors are interested in buying that particular stock or shares. The higher the volume, the greater the increase in the stock market. So this is one thing you should put into your research, which is the technical analysis. Put into your research. So to determine if this company is good to invest in, the minimum amount of value you should be looking for is $20 million. The second one is fundamental analysis. Fundamental analysis involves studying a company based on anything that can affect the price of the stock, e.g., economy or financial factors. To begin a fundamental analysis, use Google to find companies based on sectors you are interested in, e.g., companies in the technological sector. You can use a stock screener to filter market capitalization, dollar volume, industry or sector. The third one is research a company and make proper analysis of what they do, how they make money, and possibly competitors within the sector or the industry. Obviously, you want to know what the company is. You don't just want to go ahead to buy a particular stock and you don't know what the company do. You don't know what they involved in, you don't know what they even buy, you don't know what they sell, you just go and buy directly. No, you need to make findings, you need to study and know if this company is going to be profitable to invest in. The fourth one, you research and study the company adequately. How do you research and study the company adequately? The financial report of the company. Look at the balance sheet. Obviously, you want to check to see if the company is profitable. Income statement and the cash flow statement. These are the things you can check to know if the company will be profitable over a certain period of time. Another one is you analyze the company's future prospects. You don't want to do too much research. Probably you don't have the time for research, you don't just have time. You can go ahead to buy an ETF of a particular sector or industry that interests you. Probably you want to buy ETF of a particular sector like the technological sector. You can go ahead and purchase sector. There are different types of ETF you can buy in a sector and industry, whatever suits you well. Example of ETFs are Vanguard, S&P 500, we have S&P 500, we have the Dow Jones, we have different type of ETF you can buy.
Put this into consideration before you purchase your first stock.
These are the things you must know before you purchase your first stock. Number one, they must align with your long-term financial goals. For those that want to go into long-term investment. Number two, they must correspond with your time horizon. This means the number of years you want to invest for. You don't want to go and invest in a company that could go down at any time, or that will go down in the next 1 year and you're hoping to invest for 5 years. They must fix your risk appetite.
Compound interest in the stock market.
Stock market, there's something we call compound interest. What is compound interest? Compound interest is the reinvestment of your capital appreciation and your dividend to buy more stock and more shares. As an investor, you got dividend from a particular company, or you got capital appreciation from a particular company at a particular period of time. But instead of you to spend that money, you decide to invest that money back into the stock market. A smart and good investor. So this is what we call compound interest in the stock market. Also, other things you can invest in the stock market, such as treasury bill. What are treasury bill? Treasury bill are short-term instruments issued by CBN on behalf of the federal government. These are short-term government-backed securities. So when you buy a treasury bill, you are lending money to the government for a period of time. If you are someone that does not like to go into stock, you don't want to buy ETFs, you can go into treasury bill. This is backed by the government and it's also a good way of investing and getting money back. So you are lending money to the government over a period of time and they pay you a particular interest over the money you lend to the government over that particular period of time.
52 weeks low and high meaning.
In the stock market, there's something we call 52 weeks low and 52 weeks high. What is 52 weeks low? 52 weeks low is lowest price at which a stock has traded the last year. This is also a technical indicator that traders use to help understand a stock current value and how the market works. Then 52 weeks low is vice versa of 52 weeks high. It's also a technical indicator that investors use to understand the market.
Meaning of momentum in the stock market.
There's also something called momentum in the stock market. What is momentum? Momentum is a measure of how quickly a security price is changing and how sustainable the price trend is. Momentum trading is a strategy that involves buying security when they are rising and selling them when they seem to have peaked over a particular period of time. So momentum is measured by continually taking price differences for a fixed time. To create a 10 days period momentum, how do you do this? You subtract the closing price from 10 days ago from the last closing price or from the recent closing price. That's how you calculate a 10 days momentum. So that is that on introduction to stock market. If you have any question, do well to comment in the comment section, and if you want any videos of the stock market, you don't understand anything, feel free to reach out to me.
We've come to the end of this video. Don't forget to like, comment, and subscribe. Thanks for watching.